Welcome back to the deep dive. If your desk looks anything like ours this morning, November 4th, you are probably buried under just a mountain of market news.
Oh, absolutely. It's relentless.
Yeah. Hundreds of filings, earnings reports, analyst ratings, strategic shifts, all hitting the wire in just the last 24 hours or so.
It's a lot to sift through.
It really is. So, our mission today is simple. Cut through all that noise. We want to find the critical shifts, the news that actually, matters. We're focusing on healthcare, media, and consumer goods, where the momentum is, and maybe where some anxiety is creeping in.
That's spot on. And what's really interesting, I think, is who was quiet. The big U.S. fintechs, Upstart, PayPal, SoFi, basically radio silence.
Right.
Same for major pharma like Lilly, Novo Nordisk. No big news, no major filings. They just held steady.
Okay, so the giants are quiet.
Right. But the companies that did make moves, they show this this real conflict in the market. On one hand, you've got aggressive, really successful growth, but often in these very niche sectors. And that's running smack into, well, a wave of anxiety, you could call it. Institutional worry. And lots of strategic reshuffling in the more established industries.
Okay, let's definitely unpack that. Let's follow the money trail, see where things are moving. We should probably start with where the cash flow is picking up, right? We saw a couple of really big positive earnings surprises yesterday. Let's start in digital health.
Sounds good. First up, Hims&Hers Health, ticker HIMS. They dropped their Q3 results yesterday, November 3rd. And these weren't just, good results. They felt like a statement.
A statement about what exactly?
About the whole direct-to-consumer healthcare model, really. It's viability.
A significant statement, I'd say. The numbers look like a real win for execution. They reported revenue of, $599 million?
Yep, $599 million.
Which is a huge jump, like 49% year over year. But maybe more importantly, especially for investors who worry about telehealth profitability, they actually posted positive net income, $15.8 million.
That's the key. And adjusted EBITDA was strong, too, $78.4 million. They pretty much crushed expectations all around.
Yeah, they really did.
And here's where it gets, strategic. Good Q3 numbers are one thing.
Yeah.
But the real insight, I think, came from their guidance.
The forward look.
Exactly. Hims raised its 2025 annual revenue guidance, pushed the expected range up pretty significantly to between $2.335 billion and $2.355 billion.
Okay, so management thinks this isn't just a blip. They see sustained velocity.
That's the signal, yeah.
Yeah.
They clearly believe in the momentum. And the underlying advantage seems to be that subscription-based DTC model. It acts like a moat, drives high customer retention, gives them that reliable recurring revenue. That kind of insulates them from some of the pressures hitting other consumer sectors.
That's a really key point because telehealth companies often face these valuation questions, right? Especially about growth after the pandemic boom. Does this raised guidance actually ease some of that institutional doubt? Or is it just like great execution on a model that might still face challenges down the road, regulatory, competitive?
Well, it definitely eases doubt about their execution. That's clear. The market loves resilient revenue, and subscription health is proving sticky. Which actually brings us to our second positive story. It's kind of a niche win buried inside Bausch Health, BHC.
Okay.
BHC managed to turn a Q3 profit overall, which is good. But the real engine behind it was their aesthetics division, Solta Medical.
Solta Medical. Yeah, that's a fascinating little story, especially because it shows how, super localized demand can build global momentum.
Totally. Solta's Q3 revenue hit $140 million. That's solid 25% growth year over year. But connect that to the bigger picture. That performance was really driven hard by their focus on the Asia-Pacific market. And if you zoom in even more...
Let me guess, Korea.
Bingo. The Korean market alone saw explosive 96% growth.
96%. Wow. In just one country, driven by demand for aesthetic tech. That's incredible. What does that say about Bausch's strategy? Is this just a temporary surge, or is it maybe a blueprint? Focus resources where demand is spiking locally.
I think it suggests the latter. It kind of proves that these broad, generalized growth efforts maybe aren't as effective right now as targeted deep dives into markets where there's a demonstrated, maybe culturally specific pull for the product.
Right.
Solta found this hyper-growth niche in a key Asian market, and that one success basically lifted the whole BHC result. It really speaks to a very focused capital allocation.
Powerful insight. Okay, before I move off healthcare entirely, there's one big catalyst happening today, right?
Yes. AMWL. They're set to report Q3 earnings later today after the market closes.
Okay, keep an eye on that one. The consensus EPS expectation is around negative $1.83. So could be some volatility in telehealth later today when those numbers land.
Definitely one to watch. Okay, so moving from health, physical, and digital, let's jump into the always volatile world of digital entertainment. Section 2, streaming wars, M&A buzz, and global strategy shifts.
All right. Let's kick off with FuboTV, F-U-B-O. Because their Q3 announcement wasn't just about earnings, it sent like a shockwave through the sector.
Yeah, it really did.
They beat expectations. EPS was negative $0.06 versus negative $0.9 estimated. Revenue beat too.
Yeah.
But they also hit this really important operational milestone.
Positive adjusted EBITDA.
Exactly, $6.9 million. And that's for the second quarter in a row.
Which is so crucial. For years, streaming was all about growth, growth, growth. Forget profit. Seeing Fubo hit positive adjusted EBITDA twice suggests that shift towards, financial discipline. The market loves that.
It does, and yet somehow that wasn't even the main headline.
Nope. The big news. FuboTV announcing a merger.
With who?
With none other than Disney's Hulu plus live TV business.
Wow. Okay, that immediately changes the whole live TV streaming game, fundamentally.
It does. And what's fascinating here, yes, it creates a bigger competitor.
Yeah.
But it also suggests Disney, ahead of their earnings on November 13th, might be prioritizing shedding certain assets.
Streamlining.
Maybe. But it raises a tough question for Fubo. Can their operational momentum survive the huge challenge of integrating something as big as Hulu Live TV?
That integration risk is definitely real. Huge. You have to assume Disney's getting value. But yeah, offloading an asset like that shows a sharp focus on their core streaming stuff. Meanwhile, another player, Roku, ROKU. They're getting some love from analysts after their recent profit report.
They are. Pivotal Research kept their buy rating on RKU, and they actually raised the price target from $120 up to $135. That happened just about 15 hours ago.
Okay, so a nice endorsement.
Yeah, it's just analysts think Roku's shift towards platform monetization, not just hardware, is actually working. They believe in the pivot.
We should also touch on the big speculation that's kind of hanging over the sector, even if the news isn't brand new in the last 24 hours. That Reuters report from 3 days ago.
About Netflix and NFLX, potentially looking at Warner Bros. Discovery Studio and streaming business, WBD.
Exactly. That kind of mega deal talk.
Yeah.
How long does that keep affecting WBD's stock, especially heading into earnings season?
It's a great question. The market just hates uncertainty, and rumors like that inject massive volatility.
Yeah.
Just hangs there.
Right. And on the Netflix side, didn't they just approve a stock split?
They did 5 days ago, a 10-for-1 split. Classic move to improve retail accessibility, make the stock seem cheaper per share, broaden the investor base.
Got it. Okay. Shifting away from media, but sticking with major strategic changes. Let's look at the consumer space. Starbucks, SBUX, they made a pretty critical announcement about China, didn't they?
They did. A big shift in how they plan to operate there, which is, one of their most important markets.
What's the change?
They announced a joint venture, partnering with a private equity firm, Boyu Capital, for their China retail operations. And here's the key part. Boyu Capital will hold up to a 60% stake in this new JV.
60%. Wow. That's a profound pivot. Starbucks is giving up majority control in a key growth market. Why? They usually guard their brand and ops so tightly.
It looks like a classic de-risking move, probably combined with wanting local expertise. China's market is incredibly competitive now, right? You've got these fast-growing local rivals like Luckin Coffee.
Fierce competition.
Exactly. So by partnering with Boyu, Starbucks shifts some of that operational weight, that risk, off its global balance sheet. Plus, they get Boyu's deep local knowledge, connections, understanding of consumer trends. It's basically trading some ownership for, hopefully, stability, faster scaling, and a better shot at competing locally.
So it signals that maybe managing China directly from Seattle just got too hard or too expensive.
That seems like a reasonable read, yeah.
Okay, so we've hit the growth stories, the big strategic moves. Let's pivot now to the other side of the coin, the signs of market anxiety. Companies hitting 52-week lows, institutional selling. The market's clearly nervous about certain pockets.
Definitely. The insurance sector is flashing some warning signs. Progressive, PGR, hit a 52-week low yesterday, $205.31 during Monday's trading.
And the timing was key, right?
Absolutely critical. It happened right before they released their Q3 results after the bell. So that stock move, it signals the market was already pricing in significant worry.
Worry about what specifically? Rising claims, inflation.
All of the above, probably. Rising claim costs, inflation hitting replacement values, just general pressure on the whole underwriting model. Investors are clearly concerned.
And that anxiety sets up a really interesting situation for tomorrow, doesn't it? The Insurtech showdown.
Yes. Lemonade, lmnd, and Hippo, HIPO, both reporting Q3 earnings tomorrow, November 5th. You get this direct side-by-side comparison of these two disruptors trying to crack a traditional model that, well, PGR stock price suggests is under real pressure right now.
This is definitely one to watch tomorrow. What other sectors are showing stress?
Consumer discretionary, particularly apparel, is getting hit hard. Decker's Outdoor, DESA, they own UGG, and Hoka hit a 52-week low of $80.25 on November 3rd.
Ouch. What's the story there?
It's pretty brutal context. The stock's down something like 60% year-to-date. Seems to be a mix of ongoing performance issues and just a general market pullback from luxury or high-performance footwear.
That's a stark contrast to what we saw with Hims&Hers, isn't it? When things get uncertain, consumers maybe prioritize essentials like subscription healthcare and cut back on the pricey shoes.
It looks that way. Resilient needs versus discretionary wants. And related to that, Nike, NKE, also dropped 3% yesterday. No specific company news seemed to drive it, more just following that broader negative feeling in the athletic and apparel space, sector-wide worry.
We also saw some signs of big institutions maybe stepping back a bit from consumer staples and tech. Not huge sell-offs, but maybe subtle shifts.
Yeah, a couple of examples popped up. Hunter Associates Investment Management, LLC, reported trimming its stake in PepsiCo, PEP, by about 7.2%.
Okay.
And in tech, the Ohio Teachers Retirement System, Storrs Ohio, reported selling about 6,500 shares of Viva Systems, VEEV.
So when these big, steady institutional players like retirement funds start trimming, what does that usually signal?
Often it suggests they're maybe reallocating capital, moving into sectors they think have better short-term catalysts, or maybe just looking for more defensive positioning, more resilience. Subtle signals, but worth noting.
Definitely. Okay, let's wrap up our 24-hour scan by giving everyone a clear roadmap for the next day. We need to consolidate the major catalysts happening tomorrow, November 5th. It's a big day, your essential checklist.
It really is a powerhouse day, especially for comparing high-growth companies. In healthcare and aesthetics, you've got InMode, INMD, reporting before the market opens.
Okay, pre-market. Then in EdTech, Duolingo, DUOL, reports after the close, and analysts are expecting huge numbers there. Q3 EPS estimated up something like 47% year over year.
That's the consensus, yeah. And subscription revenue projected up 40% year over year. It really measures how fast education is shifting to digital subscriptions.
Massive shift. Then we get that fascinating head-to-head in beverages and quick serve.
Right. Celsius Holdings, CELH, and Dutch Bros, BROS, both reporting tomorrow. So you get this direct comparison. High-growth energy drinks versus the specialized coffee drive-through scene. Where's the discretionary spending going? High-margin energy or high-margin coffee?
We'll get some clues tomorrow. And, of course, the one we already flagged, the Insurtech Showdown.
Lemonade, LMND, and Hippo, HIPO, both reporting. It's a perfect chance for analysts and for you to contrast their different models, their customer acquisition strategies, everything.
Okay, so summing it all up.
Yep.
What does this whirlwind 24 hours really tell us?
Well, I think it proves that even when the really big headline sectors like big pharma or fintech are quiet, the market is still sending very clear signals. You see the incredible resilience of subscription models like Hims, and you see the power of highly focused niche execution like Solta's growth in Korea, but that growth is running right up against this concentrated anxiety in other areas, sectors relying on stable underwriting, like insurance with PGR, or on consumer discretionary spending like apparel with D.
And the big underlying theme.
Strategic change seems dominant, whether it's Starbucks doing that China JV or Fubo merging with Hulu Live TV. Large companies are actively trying to optimize, to de-risk, to reposition themselves.
So the key takeaway for you listening is that being able to quickly synthesize all this lets you sort the temporary noise from the real directional shifts. The market seems to be rewarding efficiency and resilience right now, maybe more than just pure growth at all costs.
Absolutely. That feels right.
So here's a final thought to chew on. With so many influential companies clustered for earnings tomorrow, November 5th, especially those competing insurtechs and beverage brands reporting side by side, are we going to see sector-wide moves that kind of confirm a trend? Or will it be more about highly individualized stock reactions based purely on which company executed better? What will you be watching for in those comparison reports? Thank you for joining us for the deep dive.